Hey everyone, Michael here. So in this video, I want to talk you through the past performance section of the company report. And more specifically, we'll go into the details of the metrics we check and why we check them. And also I'll explain some of the charts that we're going to see and basically how to interpret them and what to look for. So before we get into that though, why is it so important to have a look at past performance? Well, ultimately, if a company has proven that it has a reliable track record of performance and like it has a proven business model, then it helps make it that much easier to kind of make future forecasts about how that business is going to perform. Because on the other side of that, if the company doesn't have a proven business model and has like a volatile track record of like incredibly bumpy earnings and revenue, then it makes it very difficult to be like certain that it's like there's going to be some sort of predictability in the future. So what to look for here, or why we look at this here, is basically to see like if a business has a proven track record, then that's a great sign. But ultimately, if it doesn't have a proven track record, then it's very difficult to kind of like see that it's a reliable and business that has a proven track record. So that's why we have a look at past performance, and it's so important. So we do 6 metric checks here, just like we do in every other section, and I want to talk through them now. So the first 2 we check are quality earnings and growing profit margins. Now, I'll explain this chart first and then how it relates to those 2 checks. So just like you saw in the future growth section earlier up above, there's a very similar chart to this, except it's forward looking, whereas this is backward looking. And just like the chart above, this uses trailing 12 months figures rather than quarterly data. So what is quality earnings and how do we check it? So basically, there's 2 checks we do in regards to whether a company has quality earnings or not. The first is, does the company have any significant like one-off expenses that are non-recurring that have impacted the usual earnings that the company has? And the second check we do is, how well does the company convert its earnings into cash? And so the first check we do, being the idea of one-off expenses, is important because ultimately if a company has any one-off items that it's incurred, expenses that it's incurred, well then that impacts the reliability of the business. And those one-off items can be things like acquisition costs or sale and disposal of like assets that have basically been a one-off item that won't be recurring. And so the company will fail that check, and we look at that because ultimately if you look at a business and you see it's had a huge spike in earnings recently, you go, oh wow, that's great. It's like, oh, actually it's been because of a one-off unusual item that isn't expected to recur, so keep that in mind. Alternatively, if you see that the earnings have declined heaps, then it's like, oh, why is that? It's like, oh, it's had one of these one-off expenses that isn't recurring. Then it doesn't pass that quality earnings check because it has had quite a significant impact on it. And so that's only checked if it's a greater than 20% of earnings before taxes. So if there's been any significant impact on the business from those one-off items, then we'll make sure the company doesn't pass that check. And the next check we look at for quality earnings is like I said, the cash flow conversion. And so the thing to keep in mind here is there's 2 things. So there's accounting profits, which you see on the income statement, and then there's cash flow profits, which is what you see in the cash flow statement. And basically, the income statement can be impacted by non-cash expenses, which is things like depreciation, like it's not actually a physical expense that you pay for, and that can impact the bottom line. And there's also other aspects that we want to point out to if there's a big impact on how well the company actually generates cash profits. So as an example, say the company has a whole bunch of sales that it's made, but they haven't actually been paid for yet. Like they've been booked as revenue, like, yep, we've made the sale, but the people who they've sold them to actually haven't paid them yet. That line item there will then go to the balance sheet as accounts receivable. So it's like the business is due to be paid by those people, but they haven't been paid yet, but they've recorded it as revenue. And so you'll be able to see that if this free cash flow all of a sudden is actually much, much lower than the earnings, because it's like, well, they've recorded revenue, but they haven't actually received the cash from those sales. And so your free cash flow statement will point that out. It will be like, well, we haven't received the cash for these sales. And so the check we do there is to point out exactly situations like that. And there's a few similar examples of how that can occur, but that's just one example. And what we look for is if there's a divergence between earnings and free cash flow of greater than 20%. So in this case, the company passes the check. You can see it has high quality earnings because earnings are pretty close to free cash flow. They're within that 20% range. In a situation back here, you can see that free cash flow, the cash generated by the business, was actually higher than its earnings reported in the income statement. And that might be because there was a whole bunch of non-cash expenses incurred in that period. So that's basically why we check that, and we want to show you that the company is good at generating cash from its earnings, or there's any one-off items that are impacting it. So in this case, the company doesn't have either of those negatives, so it passes that check. And that's something to keep in mind that you look at when you look at any other business. And the next thing we look at is growing profit margins, because ultimately when you look at a business, you want to see that it's able to grow its profit margins through either reducing its expenses or keeping its expenses the same, or growing its top line more than it grows its expenses. And so we can see here that this company passes that check because its gross profit margins, net profit margins were 32% last year, and they're 38% this year. And why is that? Well, you can see here by overlaying the operating expenses that operating expenses haven't actually grown anywhere near as fast as revenue have. So we can see here that the top line, being revenue, has grown much quicker than this purple line. And when that happens, basically more profit or more money goes down through the bottom line. And so you can see this teal line here has actually outpaced the growth of operating expenses. So that's a great sign. Like when you look at a business, you want to see that its profit margins are expanding, and that's why we check that here. And in this case, this particular business does pass it. If you were to see the opposite, where the profit margins weren't growing, then the company would fail that check. And that would be an instance where, say, for example, operating expenses are increasing much faster than revenue is increasing, or revenue is like decreasing and operating expenses are staying the same. So those are two things to keep an eye out for. Now, the next checks we do are similar to above, but basically they kind of try and look for a trend. Similar to the future section, but they kind of look for a trend. So the first check we do is there a trend of underlying earnings growth? And we show here that we show it both visually and we do it in the metric here. So we basically look to see if the company has been able to grow its earnings. And in this case, it has by 27% per year for the last 5 years. A business would fail this check if its earnings were declining. So this tells us that, yep, the company has a proven track record of being able to grow its earnings. The next check we do is we compare the past 5 years worth of annual earnings growth to the past year of annual earnings growth. And why we do this is just to see if earnings are speeding up, or the growth of earnings are speeding up. And in this case, the business also passes that check. It's had 43% earnings growth over the past year compared to annual earnings growth of 27% per year over the last 5 years. So that tells you that like recent developments have been really good and the business has been performing really well. So it's actually even better than its long-term average. So that's a important metric to look at, because ultimately, if it had good annual earnings growth, but the last year's worth of earnings growth was below it, like say it was 15%, it could tell you that, oh, things are slowing down and the business isn't performing as well as it was before. So that would be a big red flag, and it wouldn't pass that accelerating growth check. And the last check we do in this part is the earnings versus the industry. And it's very similar to the future growth section. We just want to get some sort of comparison to how the business is performing versus the industry that it's in. And we compare the past year's worth of earnings growth. And so you can see here that the business has higher earnings growth than what the industry had. And that basically tells you that if you look at this business compared to all the opportunities within the same industry, it's better than average. Like, it is one of the better performers that you can see by looking at the software industry, for example, in the US. And so there isn't as many higher performers in the industry of what you're looking at. So it's one of the best performers. And ultimately, if you saw, for example, that the industry had, like it was the reverse, like it had performed better than the company, well, then the takeaway you would have from that is, oh, there might be better opportunities out there in the industry that I should be looking at instead of this business because it's underperforming its peers. So in this case, it looks like you're looking at one of the better businesses in the industry, but if it was reverse, then it might be like, okay, well, maybe I should go to the screener and search for US software industry with earnings growth above X, whatever the company's growth rate was, above X. And then you can find out those businesses that have a more solid track record. And you can see here, finally, just quickly, that also we compare it to the market. And this is not one of the metrics that we check, so it doesn't contribute to the Snowflake's performance. But we just want to show you also if there is potentially opportunities out there in the market that are better than this company as well. And in this case, it has performed very similarly to the market in the past. So it's been pretty average, or on par with the market performance. But it has been a much better performer over the last 5 years. So that's just the same reason. If it's lower, then you might be like, well, there's maybe better performers out there in the market that I should look at. And so the same thing, you could go to the screener, filter for any past performance above the company's past earnings growth, and then go from there. And so the final check we do that contributes to the Snowflake's performance is the company's return on equity. Now, return on equity is basically a profitability measure to show you how efficiently a company's management is allocating its shareholders' equity to generate profits. So anything above 20% is considered pretty good. And the reason why we do this check is we want to show you how well the company can generate profits. And we also want to compare it to the industry to see if, again, if it is, comparatively speaking, the best opportunity out there. And so by looking at this chart, we can see that the company has an incredibly strong return on equity of like 44%. So that's considered outstanding because anything above 40 is really, really good. And also we can see that compared to its peers, it is like much, much better, like 4 times better than those other software businesses out there. And so this basically tells you that it has very profitable initiatives to invest in, like it's generating a high return on its investments, whereas those others in the industry aren't generating as many profits from every dollar of equity that they invest. So the reason why we look at that is just to show you how it performs on an absolute basis on like the chart there, and then also how it performs on a comparative basis compared to those in the industry. And so the last part we have on the past performance check is basically what the company generates in terms of return on assets and its return on capital employed. So the return on assets basically shows you how much of a profit the company can generate from its asset base. And the reason we look at that is to show you if a company is like asset intensive or not and how profitable its assets are. So for an asset intensive business, something that has like a lot of infrastructure or physical assets or just like a big balance sheet of assets, it will be basically like difficult to generate as high a return if it has such a huge asset base. But if a company is a very lean, mean profit machine and it has like a smaller asset base that can deliver a lot of profits, then it's a great metric to show you that it's like a lean business. It doesn't have to like keep reinvesting in its assets. So basically anything above 6% is considered pretty good. And in this case, the industry is generating a return of about that much on its assets, the software industry. And considering the software industry isn't that high of a asset-intensive business, that's pretty average. It just means they're not that profitable at the moment. And whereas the company, this one we're looking at, generates a return of 20% per on its assets, which is just outstanding. Like really efficient allocation of like of the profit it can generate from its asset space. So that's great to see here. What you want to look for is basically how it compares to the industry. And if it's below, then it's like, well, there might be more businesses out there that generate better returns on their assets. But in this case, the company far surpasses the average, so it's a great performer. And the next check we do is the return on capital employed. And this basically is similar to return on equity, but it shows you how it allocates its capital as a whole, which is basically total assets minus current liabilities. And why we do this check is we just want to see if this measure is improving or not. So we don't compare it to the industry, but we do compare it to how well the business did it 3 years ago. And so you want to keep an eye out for if it's improving or not. And in this case, we can see that it is. The business generated 18% per year, 18% return on capital employed 3 years ago, and now it's generating a return of like 29%. So anything above 20 is considered good, and the company is, again, proving that it can generate very profitable returns off its investments. So that's the kind of trend you want to look for. You want to see that it's improving, and if it's not improving, it tells you that, well, what they are investing in isn't as profitable as it used to be. So that's something to keep an eye on. Now, that's the past performance section, and if you've finished that and you basically get to the end and you're like, well, this business doesn't have a reliable track record, it's very hard to make any forecasts on like its unreliable history, I want to look for better opportunities out there, then we have this next steps section here, where you can go and look at companies that are also in the software industry but have like a very strong past performance. So if we were to decide this company there, we looked at past 6 out of 6, so it's probably one of the best out there. But if it didn't, and we wanted to look at other opportunities, we can look at the US software industry and look at those that have a sustainable track record, which basically means they've been able to reinvest their earnings sustainably, generating more than 10% growth per year over the last couple of years. And so you get to look here and basically see how it compares to others in the industry. So yeah, that's pretty much how to use the past performance section. So I hope that was helpful, and thank you so much for watching.